Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me Ketan Patel. How you doing, Ketan?
I'm doing great, Lance. Thank you for having me on the show.
Yeah, you're welcome, man. Thanks for joining us. So why don't you share with us sort of how you end up getting into this business? I know you've got an interesting, you got a coaching practice, and you do some fundraising and some other things, and big educational bent to you. But maybe share with us sort of the origin story. How did you end up getting into the real estate world and real estate investing and all those things?
Yeah, sure. Happy to share. So originally, I'm an immigrant from India. I came here not speaking English, started working on my doctorate of pharmacy, and I became a pharmacist, and I'm practicing pharmacy. And I realized I need something on the side, right? I just don't want to rely on this corporate income. So initially started buying some single family homes, then 3-unit, 5-unit buildings, started growing the portfolio. That was my entryway into the world of real estate. But as I started spending more time, I realized that I need to have a strategy to grow the income, and I just need to be having a good plan. And then I got into syndication and multifamily and coaching, and one thing led to another.
Mm-hmm. Yeah, that's great. So for you then, now that you've kind of lived the whole go buy houses, tenants and toilets and all that stuff. It sounds like you've sort of made that transition to more passive yourself, and I think that's what you spend a lot of your time sort of talking about and educating passive investors, much like we do here on the show. And then sounds like you also help coach some of those active operators and help them sort of get in the right mindset around just the self-limiting belief, right? Because the real estate business is hard, because there is no such thing really as, and if there is, I think it's probably a bad sign, but it's more of a linear growth type of business, right? And there's really no free lunches, there's no shortcuts. It's just day after day after day, and if you just stick with it, it really is. It's a long game. It's not a get rich quick sort of deal. But that also, I think, leads to you can grow weary and tired, right, of fighting a good fight, and especially when most of your compensation is sort of based on your ability to execute, and you won't get it until you sell these assets, which is some date in the future. So maybe just share with us how you ended up kind of finding your niche here, right? Because like I said, you started as a pharmacist, you're doing your own thing, but you've really settled in to, I think, what is not to say there's others that aren't like you out there, but it's kind of a unique position that you sort of landed in.
Sure. So I realize as I spend more time in real estate that we all have unique makeup, right? The passions we have, the personalities we have, our values. There's so many combinations. And if that's the case, why are we not even questioning our approach and just taking that standard approach of maybe I need to buy buildings, or I need to do this, or I need to do that? If we have all these combinations, certainly the approach must have all those combinations too, right? So through trial and error, I figured out that it's not my strong skill set to necessarily manage the construction or manage the contractors, right? The hard skills of fixing and flipping, so to speak, that's not my thing. My thing is more analytical. I like numbers. I like talking with investors, the mindset. So we all have certain buckets, right?
Mm-hmm.
So kind of figuring that out and then developing a strategy along those lines that would fulfill our goals as well. Instead of just having financial freedom, one goal, and just try to just invest and just being generic, because then we don't have the edge that we are looking for. And when we have a strategy that we enjoy executing, then it becomes fun, that even if you're not getting results, you like to do it. And then slowly, naturally, when you like to do things, you'll do more of it, which will produce some results, reinforce your belief. And that's a much pleasant way to get to your goals versus just trying to, climb that rock and just trying to, have the grit and go through with the grit just to acquire the property or scale your business.
Yeah, exactly. Just, yeah. Cause I think that is, you see, it's sort of inherent in I call them deal junkies, right? But it's also, a lot of the real estate guys, it's, you have to be a grinder, right? Like, because you got to be out there, you got to be picking up the phone, you got to be answering the phone, you got to be, you turn over lots of rocks, kiss lots of frogs, you do. So that is in their mindset. It's like, well, I just got to keep going. I mean, the good ones, I mean, that's innate in them. In fact, I think that's the part that, that they like the chase and they like the whatever, but yeah, over time, it can wear you out, it can wear you down. And that's what's been good in the last 5 or 6 years, just to hear. I think when I got in this business back in 2008 myself, and I'd say even 5, 6, 7 years ago, I felt like all the participants were playing this zero sum game, right? Where it just was like, it just, if someone else won, then that meant that they lost. And it was sort of this, what I observed is seemed to be very lonely and isolating, right? Like, well, if everyone's playing a zero sum game, that basically means that you have no allies and that it's basically you versus the world. Right. And what I've seen in the last handful of years is people embracing a much more, I'll call it, co-opetition, or even, just team play, right? Of realizing that, hey, doing this with a handful of people and finding, like you're talking about, where you can align yourself with someone who's better at this other thing. Like it might be investor relations or fundraising or asset management or, negotiation, acquisitions, whatever the case may be. And just realizing like that's more productive. And than to try to just go out and just, beat your head against the wall and do it all on your own. So for you then, as you sort of, had the aha moment and realized like, hey, find my place and run my race sort of moment. Do you use the coaching practice then as like a means to begin building relationships with the hope that, as you walk them through your process and that sort of thing, that it's almost like a vetting process as well? Like, do you find yourself often then becoming and helping raise capital for your clients that you've been coaching, or, are they sort of, you treat them mutually exclusive? How do you do that?
So basically, they are both separate businesses, because what happened was, once I left pharmacy, I also had a senior care business that I put on autopilot, and I had a lot of time on my hand. And I started growing the syndication business, and I started asking myself, what does it really take to be successful? So I started diving into mindset, getting all sorts of training, thinking that I was doing it to grow my real estate business, but I was just passionate about it. And I realized that if I'm impacting people with investing choices and things, why not also impact them at another level, at a higher level? And it's something that I enjoy doing. So I use those two as like separate practice areas that I've developed over the years.
Yeah, that makes sense. I mean, I think I can relate to that, right? Like, when we started this journey, it was, we wanted to launch our own, private equity real estate shop, or kind of pivot into that from being exclusively hard money lenders. And then it became, hey, well, we can coach and advise on architecting and structuring investment opportunities and charge a fee for that. And then, but then it became, one thing just leads to another, where you realize like, hey, we can help them in greater ways. And over the course of, now what amounts to, kind of, 12, 13 years later, realizing like we can continue to even add value in other ways, like, provide a directory, allow people to be discovered, help validate them. And, we're working on launching like an accelerator to help people become, fund managers and investment managers, private equity real estate, for just make them better. Right. And so, I mean, I think it makes a lot of sense, and it's a lot more fulfilling then, because you're impacting people in a much deeper, deeper way. So that's great to hear. And then in terms of for you then, because then it does, just like us, I feel like you run into at times more conflicts of interest then, right? Because it's like at times when you're doing these things, you end up bumping into two sides. So if you've got a client that you're coaching and they've got this deal or the syndication and they need help raising money, but you don't like the deal, or you're not yet comfortable with them as operators, or do you run into that? Have you run into that? How do you handle that? It's sort of, I'm assuming, can be some difficult conversations.
Yeah, no, that's a great point, but I haven't ran into it because when it comes to raising capital, my model is to just work with, sponsors with a certain level of assets and only work with very few sponsors, so to speak, because I'm evolving the business model that side. And on coaching relationship, it's just giving that mindset strategic support that's clear that I'm not helping them in the capital raising, because I also realize that I have less control when I'm bringing capital to other deals. So if I just start to plug money left and right, it increases the risk everywhere. So I'm just being very, very slow there, because I had the privilege of running that other business where I don't have to worry about income, so to speak. Versus if this is the primary business and you have to keep the lights on, then you just have to look at it very different angle, right? Versus, hey, I have passive income. Let me just move on raising capital pace at my own pace, so to speak.
Okay. Yeah, that
Yeah.
makes sense. So when you did, just walk me through like the process that you sort of followed when you were narrowing down those sponsors, like who you would be willing to, what was your due diligence at the sponsor level? Then I'm always curious too, as to like how you, when one of those approved sponsors provides you with an opportunity to raise for, what because you mentioned you're analytical. I'm just curious as to, how you do that. But starting with the first things first, right? Like, how do you get to the point where you have enough comfort? What was sort of your sponsor due diligence process? What's that look like?
Yeah, so that's a great question, right? And it is challenging to find somebody that would meet all the box. That's what I would realize too. That perfect sponsor, the perfect investment doesn't necessarily exist. It's just picking what kind of makes more sense for you, right? So on a sponsor level, number one thing would be looking at their operating history and seeing what their structure looks like, right? So if it's just one person running the shop part-time and they have a W-2 job, how does that look? Or is it two people full-time, but they're acquiring so fast, but they don't have asset management team in place, so to speak, right? Or whatnot. So looking at their personal structure, their experience, their operating history, that's like number one thing to speak, right? And then before that, even we get to it, it's important to have a values check, right? What are they really valuing in terms of, is it somebody that would go above and beyond when a deal's going to have problem with an investors, right? Or some issues with managing that deal? Are they going to be open in terms of communicating? And what are their values, right? We want to find something compatible there. And then if the sponsor, their team, their platform, that makes sense, then the next step would be the markets they are focusing on. What are their deals, the numbers? Do you like their underwriting, so to speak, the rent projections they are assuming, and all of those things, right?
Mhm.
And then you could also do a variance check, so looking at their previous deals and how they are performing now, and looking at the variance and seeing how that's adding, and if they have done exits or things like that. So these are some basic things just to kind of check boxes and move people to the list. And then the logistic facts of what is the minimum capital do you need, and the operating relationship between us and all that.
Yeah. So then that's when it gets to sort of the deal level. So, I mean, I know that you've got, it's a small group of people that you work with currently. It's always good to hear like, yeah, these are the sort of gates that you had to go through for you to be like, okay, I'm comfortable, and I think it does. It's team, right? Who are the team? Do they fill all the seats, right?
Yeah.
Who's in charge of acquisitions? Who's in charge of asset management? Who's in charge of investor relations? Who's in charge of back office, administration, right?
Yeah.
Because it's like, great, they're great acquisition guy, they're great at negotiating stuff, but on the execute, especially if it's a value add strategy, right? Like the ability to, there's rehab and construction, and it's a different animal. Right. So that's sort of, okay, feel good about the team. And then it's a matter of sort of that character side of it, or who are they, the values, and those things. Like, do we align there? Do I like how they look at the world and their philosophy and how they've handled things, and then their performance? What have you done? Because obviously, as you said, it sounds like you stick to more, have to have a certain amount of, the track record has to have some amount of, they've done this before to the tune of X millions of dollars, 50 million, 100 million, or whatever.
Yeah.
And only then, once you get to that point where it's like, okay, I like the markets you invest in, I like the property types, I think you got the team, you got the sorts of things, then it's, hey, we got a deal. So when they hand over that, underwriting package to you, because that's kind of like we said it before we hit record here, right? But like for you in your position, that's kind of what's nice, is because you are more analytical. You'd like to teach, you like to do those things. So the ability to kind of get that underwriting package then and dig into it and figure out, whether this sort of meets your criteria. Because obviously a lot of stuff is just a pro forma, is they can just plug in, oh, we're going to increase rents $400 a month or something. So
Yeah.
how do you do that? Like, what's the first thing that you go to when you get that underwriting package?
Yeah, so that's a great question, right? So as the business has evolved, I realized I need support around that, because there's only so many deals that I could vet, or I could be overlooking things. So I have members on my team that help me with the underwriting pieces as well, right? They are checking some of the things. But what I like to see is the rent premium is the number one thing, as you know, when it comes to value at apartment. Is that sustainable or not, right? So checking that against a CoStar or a multifamily research report. That's number one. When allowed, the markets I'm not familiar, making some calls. The challenge is, as you know, the unit sizes and the amenities. It's so many things that going on there. It's hard to compare apples to apples, so to speak. But having another data point there, right? Just going on apartment.com, searching things there, going to LoopNet or some other sources and looking at other deals that are listed in that market and checking their packets, because their agents would have other deals, just to kind of see the points that might not be in your sponsor's packet, or you might not have thought about, right? Looking at these things, and again, it's not a hard yes or no, but the more data, the more feeling you get to be like, okay, this seems like manageable, and that we could achieve $200 in rent premium or whatnot.
Sanity. Yeah. I call it sanity checking, right? It's
Yeah,
just like,
yeah,
okay, is this really going to happen? Right. Like, and it's,
yeah,
of course, it's parts science and probably more parts art, unfortunately, but it really is trying to take in all the variables and totality of it, and then weighing it against the experience of the team and their ability. Can they execute? Will they be able to, what is the likelihood that they'll be able to execute this business plan? Right. And it's, if you can't get your mind wrapped around what the plan is, or there is no plan, then you've got a problem. Because that inside of all these acquisitions, and I know it's like, it's great because some of these deals have really nice pictures, really nice swimming pools, and the tombstone out in front just got a little fountain, and it's just, that's great, man. That's awesome. But, they're just pictures, right? And it really, it's these sorts of things. Like, there's human beings that are going to go on apartments.com that are going to find this apartment, and they're going to, not just this apartment, but 5 others or 10 others. And they're going to say, would I want to live there for that price? Like, and that's, so to me, it's like teleporting yourself into their shoes of the consumer. Ultimately, someone's deciding, do I want to be a resident of this place, or will I, if these things happen, would I choose this one over this one? Because that's what happens. And then that goes to the depth of the market and, all those things. And it's just, but that's the kind of stuff that, like, having someone like, you didn't prepare the stuff. You're the one who's having it sent to you. You and your team are basically on that other side of the table. Then making that decision that, hey, we like this project. We would love to be a part of it. So then the next step for you is to do what? Like, it's some sort of just saying, hey, we would like to, we feel like we could take an allocation of X dollars.
yeah,
We'd like to raise, let's engage, sign a selling agreement, whatever the case may be. You're going to have to run it through your broker dealer, to
Yep.
get approval on.
Yep.
That's kind of how it goes.
Yes, you're correct. It's just that, and the other piece is, you're always rather than transactions, relationships always wins when it comes to developing relationship with your passive investors. So they are investing repeatedly, they are growing their wealth, they are learning a system with you, and you're doing the same with the sponsors, looking at multiple of deals, scaling it. Because otherwise, just looking at a transaction here, transaction there, doesn't really support at least the business model that I'm in, so to speak.
Yeah. And do you stick exclusively to multifamily? Is that sort of your?
Yes, for now, I'm sticking to multifamily because I realize that, yes, there are different asset classes, but they behave differently as well. And just looking at some packets and, understanding it theoretically is just not enough, because I know that on a smaller side, the 3 unit, 5 unit buildings, I've built a portfolio, and the management challenges there when it comes to flipping. I've done luxury construction as well. You have the business plan, but then it meets the road, the reality,
Yep.
and everything's different that way. So until you could really understand how your team members will be able to execute and whatnot, I think it's safe to just limit the number of asset classes, because offering's not that challenging. It's very easy for me to, on a conceptual level, understand and educate my investor and offer. But I think it would still be a little more risk, versus I'm tracking some of the other classes, looking at packets and looking at things. So as time goes, I could make those decisions.
Yeah, I agree. I mean, and I think that's just it too, right? Is that it's. I mean, I say this all the time, and it's what Warren Buffett said, right? It's like you invest in things you understand. It doesn't, and I think people misinterpret that. Like they mean, like they thought that it meant that Warren Buffett hated the iPhone, or he thought technology was dumb or something. And it's like it's not what he said. It's like it's not that he's no dummy. Like he clearly understands. He. It's not that he didn't know those things. What he means is I like to invest in things I really understand, like I really, really, really can get my mind wrapped around. That's when he invests, because now we've seen years later, he doesn't just invest in banks and railroads anymore. He does invest in technology, which means once he got to the point where he felt like, you know, he actually had ample time to get his mind wrapped around how certain things work, then he developed the competence and the confidence that he needed. It's the same thing for guys like you who are in the seat and position you're in. It makes perfect sense. It's not to say that you don't understand, value add office or industrial or, or self storage or whatever. It's like, that's not usually what it means. What it means is how well do I understand it? Because in your position, you're affiliated with the broker dealer, you're a registered representative. It's a higher bar, right? And
Yeah.
when you bring something to market, like you need to have that end user's investor, their best interest in mind, which means that you need to understand what you're selling well enough to make sure that it meets, is suitable for the person who may want to buy it.
Yes.
Right. And if you're out there like, prematurely hawking, all sorts of, crazy other asset types, or whether they're crazy or they're not, it becomes fuzzier and harder to sort of stand behind that. And I
Yeah.
think that even for the passive investors, it's the same thing, is that when you get into this business and you decide you want to invest in these real estate, alternative investment space in general, real estate, private placement specifically, it really does become sort of the, hey, multi is the easiest. I mean, it's like we probably all lived in an apartment, right? Like start with those things because it makes the most sense. It's the easiest to learn. It's the easiest to get to a point where you have enough competence to allocate capital, confidently,
Yeah.
is sort of the approach. So for you then, when after you like, it's a position you're in, like when you do find a deal that you like, and you bring it to your investors, and they allocate capital into it, do you then handle like all of the the reporting and the communication for those investors? Because I know that that's often like a bit of a problem I mean, it is a problem in the industry. A lot of people, that's sort of where they fall down, is they're not very good at the communication side and the reporting side. So how do
Yeah.
you ensure that meets sort of the standards that you're shooting for?
Yeah, so that's a great question, right? So when we're doing the sponsor due diligence, asking to be on list for one of the deals that they recently did, right? And then letting some time go by. So this will kind of help to see, what the sponsor's protocol and things like that are, because ultimately I'm waiting for them to give me the data around the apartment and things like that, right? It's in their hands. So that helps me before even that relationship. And ideally, if possible, I've invested too. So you could see what the LP experience is like on the other side. And then if you see the communications are being done right and things like that, then when it comes to the transaction, it's easy for me to kind of take that material and share it with the investors instead of chasing them for the communication.
Yeah, exactly. So for you, multifamily, how about the markets? Like you mentioned that there's certain markets that you kind of prefer, and that's sort of how you got to the sponsor selection and things like that. So
Yeah.
what markets are you sort of bullish on right now, or that you really, you feel comfortable with? Um, yeah, I'm just always curious as to,
Sure. So, I'm from Boston. So, as you know, the rents in these coastal markets and the things, they just are. So even before COVID, you see population migration to the southeast, right? So I like the DFW on a macro level, the DFW, Atlanta, South Carolina, North Carolina, and then in Florida, Orlando, Jacksonville, Tampa, the southeast focus basically. That's where I'm focusing a little bit more on in observing, because those markets, comparatively, the cost of living is cheaper, the climate's better, some of the states are business friendly, so all of those things, are helping the multifamily sector.
yeah. And then are most of it's usually value add stuff, or do you do any like more core type?
So sure. So normally value add, but if it's a fund, then we have a little flexibility, so to speak, because the fund's trying to hit a certain number, and if fund has a core plus and a value add and a value add and a core plus, it would be fine. But independently, we try to do value add. That way, there's some room in the deal as well. If we are not getting the rent premium or something like that, and from value add, it turns into a core plus or core instead of going into just a core deal right now and not having the room, so to speak.
Yeah, exactly. It's yeah, because I think that's what you hear a lot out there. Is just, I mean, it can cut both ways, right? Because some people are saying, well, the cap rates even on a value add like the DFW is an example. It's like you might as well be buying core plus stuff, because I mean, if you're going to transact, and I think those are the little subtleties, right? Is that every market is always at a different point, and I mean, even obviously down to the sub market, and not, once again, not trying to make it more complicated, but those are the little things, that those insights, and it's fluid because these things change, right? Like, let's think of like Austin right now. It's just, it's crazy. I mean, it's just, there's so many people that are, it's, everyone's moving there. Just, there's a hub of activity. So it's definitely a little bit harder. There's, real estate is inherently not very volatile, but that's some of the stuff that's hard when you get in times like this, especially post COVID now. We're all trying to figure out. I mean, the banks, as of today of this recording, right? They just, a lot of them had a bunch of those, loss reserves they've released, because, you're not seeing. So there's a lot of good signs, right? But once again, a lot of the things that we're experiencing in this economy are really, they're unprecedented.
Yeah.
Meaning even economists, they've never seen anything like this. We don't have precedent with the modern economy and the way these things are. Once again, not trying to scare people off and not to transact, but it's just like the combination of variables and factors that we're dealing with right now are just, it's hard to get your mind wrapped around. And I know it is for me. And I host a podcast where all we talk about is this stuff. And I'm reading the journal every day, and I'm doing all stuff. And I'm like, holy smokes, man. I just don't know what to think. I just don't know where we're headed with all this stuff.
Yeah, you're so right. And I feel like sometimes the new stuff we learn, instead of it solving our problem, it's making more questions. Is this model even right? And then it just kind of keeps going in and in. There's just like a never ending thing, so to speak.
Yeah. And I think that's, and it goes to, and that's often is the case here, is that, I think a big part of it is, discipline, right? Finding operators and people who just have that, that are just disciplined, right? Meaning because what we're really saying, right, is that it's hard to predict. Like the market is, we don't control, right? We don't. Those are it's out of our control. The things that we can control, though, is to have a philosophy and a method to our madness, right? Like things that we believe, and if we make, you know, narrow that down, like this is the criteria for how whether we will transact or won't transact, right? And then if you're actually good at what you do, meaning that you have enough experience to be able to, you know, react to any sort of thing post transaction. I mean, it's just the problem is that if you can't just create some stability, there's got to be some constants, right? Like this is how we decide whether we transact, even if you know, have to move things around a little bit instead of just getting in these bidding wars. Because I feel like that's kind of what I'm hearing on the street, right? It's just that there's some people out there that are transacting just for the sake of transacting, right? And they just feel like they can somehow just work their way out of anything, and that tells me that you probably lack discipline and probably don't have sort of that method of the madness or an underwriting model like that, you know. And that's the sort of stuff, is that no one has a crystal ball, no one knows, but the signs to look for when you're speaking with potential people to invest with is just, do they have a method of their madness? Do they have conviction about their strategy? Right? Like if it's always like, maybe sometimes we do this and sometimes we do that, and then we like this and we don't like that, like that's the stuff that can get pretty scary. You're looking for people who've got like, this is why I do what I do, right or wrong. Like this is how I do it, and this is why I do it. And until I'm proven wrong, I'm not, you know, sort of moving off of it. Do you see that out there?
Yeah, I mean, you made great points. I agree with, you know, everything you said. And to add to that, in terms of passive investors need to develop their own model, so to speak, because what I realize, or my philosophy is, picking one or two or three right investment is not really going to get to your goals or end it. So you, as a passive investor, the more you could learn and develop your own system and kind of test it out. So as years go by, you just become savvy, and intuitively you just start picking more and more right investments, versus a lot of times passive investors are too concentrated on this specific deal and the IRR and things like that. And now what happens? It could exceed the IRR, but somehow that deal's done, you're exited, you're back to square one to find a sponsor, find a market, the whole thing, right? So
Yeah, that's right. I mean, and there's been, you know, it's obviously with the passage of the Jobs Act, that's been tremendous for creating access, right, for, you know, the everyman, normal people, you know, so that's all good, and it spawned sort of what I call, you know, real estate crowdfunding v 1.0. You know, but what we've seen in the market, right, is that it's sort of developed, you know, which I guess is good for the crowdfunding portals and platforms and the operators who are, you know, on them. But there's this FOMO, this fear of missing out, where people are just, you know, piling into an investment, you know, in 7 minutes on a webinar or whatever, right? And it's kind of speaks to what you're talking about, where, hey, maybe that deal fits your box or your portfolio needs that investment. That could be, but I do think it, to your point, just like you should expect the operators or the developers, or even in the case of, you know, you and your firm, right? Like the sort of like allocator or the, you know, register rep, whatever you call you, sort of that trusted advisor, I guess is the way I look at it, is that with someone like you in the picture, you sort of expect a little bit more. That's where that extra guidance that you can provide is to help them sort of diagnose what their portfolio needs, but just staying away from having the same discipline. To your point, is that your portfolio has needs, and you need to start there and say, what does it need more of? It might be that yours actually needs more income. So if you like multi and it makes sense, and maybe you should be going into more of a core plus deal, right? Like a cash flowing deal or whatever the case may be. The point is, just because that has fancy pictures or whatever, that's the deal of the week on the platform. Don't just blindly start throwing money in it, right? Like,
yeah, absolutely. And feeling, investors have to know that investments are just like buses. The one goes out, you know, the next bus is going to come. They never have to feel that if I miss this, it's over. And you know what? If it's midnight, there's 6 hour delay, the morning bus is coming, right? So just at least having the patience and not acting on that impulse or that fear of, okay, if this one's filled out, I don't know what I would do. I always tell people like, wait, it's okay. It's not end of the world. If you wait, something is going to come up, right? So,
Yeah. And
yeah.
that's what's so exciting for me is just to see the proliferation. Like I said, one thing, the teamwork and the people realizing like, okay, we're not playing a zero sum game. And it's a version of this. And the fact that there's so many more people now, the proliferation of podcasts like this and guys like yourself who are just, wake up in the morning, like I'm going to teach people how, to attain financial freedom through multiple income streams and the dedication to educating. Because when you think about it, right, like we could have done this in 2005, 7, 9, 10, every day before the Jobs Act. All the operators of the world could have tilted up educational platforms that where they were not selling securities, right? It could have been done before, but it wasn't. Because when I got in this business, it was pre-Jobs Act. And it was just like prior business relationship, you can't do stuff, you can't do whatever. And then it's like, isn't it funny how like post-Jobs Act that the vast majority of the offerings are still 506B offerings and they never see the light of day. And most of the people are executing a strategy of, content-based marketing and education. It's funny how that works, right? Like HubSpot, as an example, their whole premise was, inbound marketing and, educate. And that's how the world is as far as like consumerism, how we consume is we go out, we educate ourselves. We're now a more, educated consumer, and then we make educated decisions. So it's, I love seeing it though, whether or not it is kind of a circuitous route to sort of get here. But it is good to see more of that. So with that being said, where can people learn more about you and get on your list and get some of that content? And where do they find you?
Sure. They could find me on Mukhi, Mukhi, capital CAPITL.com. And I also have an option there. Feel free they could book a strategy session or contact me if they want to talk more details. So
cool. All right. Well, it's been great. Thank you so much for taking the time. I appreciate having you on.
Thank you so much for a lovely discussion.
All right.
Thank you.
Take care.